I think we should start.
Yeah, we can start, no problem.
Okay. So, yeah, I guess good morning, everyone, and welcome to the ESCO Association of South Africa's funding webinar. It's the first that we are hosting. Look, the format of today's session is definitely not going to be death by PowerPoint. What we wanted to create with this webinar is an opportunity for our members, the ESCOs, to engage with an extremely capable and experienced panel of, let's call them funding subject matter experts. And when I introduce them, you'll understand why I use those words. We planned the session in such a way so that most of the time, probably 70% of the time of the hour that we've allowed, will be open for discussion and Q&A. So I want to invite everyone who's here to really participate with enthusiasm. We want to understand what sort of questions you have when it comes to funding. What challenges have you experienced? What sort of pitfalls have you come across? And the idea then is that we can help to move forward and to get funding for your project. So without further ado, I'm going to introduce the panelists, the subject matter experts. We've got both Sinjan Banji and Jock Brown are from Broadreach Capital. And then we have Mark Dawson from Capital Box. So Sinjan's career spans 25 years in financial services. He's been in various roles from stockbroking, banking, and asset management. And most recently, he's been involved in private debt and equity with an emphasis on impact and responsible investments. And I mean, this is obviously the space that we're in. And since he's joined Broadreach, he's been engaged in corporate finance and business development in the renewable energy sector. Like I said, Jock is also from Broadreach. He's an engineer with 15 years experience in global energy and technology industries. I see, Jock, we both share a history in chemical engineering and project management. So, and I guess we also share an interest in funding. Jock's worked across the world in countries like New Zealand, South Africa, the UK, and Norway, and he's delivered projects all over the world. And then finally, we have Mark, who's the co-founder of Capital Box Asset Finance. His career spans 30 years in asset finance and banking. He's worked at Citibank, where he headed up the asset-based finance team, and he's worked at Cape of Good Hope Bank, and he's also worked in the UK for Admiral Leasing and Golden Arrow Finance Limited. And Mark was one of the founders of the First Health group of companies. So, I mean, I can go on for much longer, but I guess this is enough. And like I said, I hope you get an idea that the people that we have and that we got together to speak with you today really know their stuff. I know some of the projects that Broadreach have funded, and it spans a range of projects from renewable projects to energy efficiency projects. I got involved with Jock and with St. John when we were looking at funding energy efficiency projects in the retail space. And I want to thank all three of the panelists for their willingness to participate, the preparation that they did, and the knowledge that they will share with us today. Then you've all seen that we are making a recording of the session. It will be shared with all the attendees. And finally, I just want to give a big thank you to the SAWC for taking care of the arrangements for the session, for the marketing. Claudio, thank you very much for setting everything up. And I think once we've had this, at some point soon after the event, we'll send out a questionnaire to all the attendees. It's important that we get your feedback on how, what was the value of this and how we could improve. We could potentially have a follow-up session on this one because the session is short. We want to test the waters and see how we can help and where the ESCOs are when it comes to funding. So that's enough from me. I guess, St. John, are you going to lead the presentation, the short presentation bit?
Yeah, I will.
Thank you, St. John. Over to you.
I'll lead, and the team will chime in, I think.
Okay, excellent. Thank you.
Can everybody see that?
Yes, we can.
Let me just try and put it up a little bit bigger. Is that better?
Yeah.
Perfect.
Okay, can I kick off? So thank you very much, Ricky. And guys, we really want to make this a discussion, not a presentation, which is why we kept it short. There's also a difficult one because it's difficult to know like what levels to pitch things into. Some people have a better knowledge of finance, some will not, and so I apologize if we've gone sort of too low on where we've pitched things. I'll sort of take your feedback as we go. All right. So we've already had an introduction, and I won't sort of labor who we are, but we founded this business to be the bridge between. Oh, I'm getting a lot of feedback. Can everyone mute themselves? Okay. Yeah, we founded Broadreach. The vision behind Broadreach was to try and be the bridge between the technical and the financial worlds of green energy. And it really was, it came out of a need where these two worlds don't seem to speak to each other. And that's maybe why we're here today. It's the financiers speak finance and the engineers, speak project finance. And often when you find you get everyone in a room, what is quite simple becomes a very difficult project to actually get away. And whether that's energy efficiency or PV or storage or a hybrid system, the idea was that if you put a team together of people who spoke both languages, it might be a little bit easier. So yeah, we help design and finance a range of energy solutions across the spectrum, both in terms of sectors and both in terms of solutions. I know we focus particularly on energy efficiency today. I think, yeah, we maybe just to finish off on a sort of our CV, and then last year, we built traction with our own money. Adam, Jock, and I founded the business, and we built some traction with our own money and they call it friends, families, and fools money, getting our funding pipeline working. And then last year we concluded a almost 500 million rand equity transaction with Meteor Sustainable Capital, who now fund our yield co. And so we have quite a lot of, let's put it, dry powder to fund projects. One of the main things we saw though is that once you get below the small utility scale and sort of large corporate, so some top I don't know, top 200, 300 corporates in South Africa who are easily bankable. And we'll talk about it in the presentation a little bit more. You know, these are corporates who already have decent funding lines with their banks and other financial institutions. In that, what I would call large SME, medium SME, down to the smaller SME space, there really is very little access to finance. And, you know, I'm thinking particularly projects in the sort of R1 million to 3 million rand type space, whether they're energy efficiency or green energy projects generally, are just not getting banked at all. And we reached out to Mark and his team at Capital Box, and we formed a joint venture to really try and focus on banking that sector of the market. I don't know if Mark wants to just give a little bit of background to Capital Box, and then we can carry on.
Thank you, Sergeant, and thank you also, Frikkie. Yeah, so Capital Box, you know, we're a team of asset finance specialists that have a experience across a number of industries. But I guess our forte and you know, where we really add value is in the SME space and the SME market. And as Sergeant pointed out, you know, largely a lot of those particular businesses are owner operators, they're entrepreneurs, and they're small cap businesses. They're not on the radar, and generally that these are people that operate in a space where they try to do everything themselves. So whether they you know, banging out a quote, doing the work themselves, so typically they don't have the resources to like a larger corporate or a bigger company has, in terms of putting their finances in order and you know, generally making themselves an attractive proposition to a tier bank. So you know, that's really where we come into play, because of the inefficiencies that the banking sector has and their inability to look after this market. We have a role to play. So we've been around for many, many years, and we've done you know, some very, very successful projects over the years. We've got an extensive customer base. We've got something like 6,500 customers that we interact with, either on a frequent basis or at some point in time. We have great strategic relationships with some major equipment suppliers across all industry sectors. You know, so there's some global names that we deal with, the likes of the G's and the Philips and the Siemens of this world. In the medical sector, certainly in the food processing and manufacturing sector, we deal with the likes of the Freddie Hirsch's. In pharma, we deal with Merck and Roche. So these are proper names and proper organizations that supply capital equipment into the SME and the small cap market. And we have these relationships and strategic partnerships in place to facilitate funding for those particular customers. So I think I've kind of said it all. You know, I guess the focus that we have is a very much a personalized approach to customers, and we try and hold their hand to the whole credit onboarding process and the application process, which is very different to which and how the banks operate in this day and age. So that's kind of our difference and our value add. And I guess through the Q&A, we will be able to answer some more specific questions, how we deal with credit applications and what we look for.
Thanks, Mark. So, so yeah, the JV between Capital Box and Broadreach was really to try and build a green energy and energy efficiency finance product for exactly that market, for the smaller SME market, using Capital Box's skills with that market and our green energy finance skills together. So the problem set, I mean, you guys are, this I'm telling you stuff you already know, but you know, our utilities generally are degrading. And I mean, the further you go north, the more you see that whether it's power, whether it's water or sewage, utility services generally are not what they used to be, and the delivery of them is more uncertain. And large corporates, you know, are able to put their hand in their pockets to put those utility services from the private sector, that they're able to fund, whether it's water treatment, power, energy efficiency. They see the opportunity and they're able to fund it from cash resources or sort of readily available finance from their financing lines from their financial institutions. But in a world, in the world we sit in today, which is, and I suppose I'm being optimistic saying that it's post-COVID, but for most of the rest of the world it is. But in a semi-post-COVID world, and given what we've been through in the last couple of weeks in SA and in Swaziland, like what are the real options for small to medium-sized businesses that are already under stress, they're already cash constrained, they've already, having issues covering salaries, and now they're hit with these challenges, and how do they fund them?
I think it's also worth pointing out, St. like when you're talking about utilities, energy production, water, what have you, you're talking about large capital costs up front. You're talking about spending a lot of money for something that's going to last, 20 plus years, and those cash resources aren't readily available, even for big businesses. They're not necessarily available, but it's a large amount of money. I think that's the key.
Absolutely, Jock, and I think, not to put too fine a point on it, a lot of SMEs and medium SMEs are focused on making it through the next 2 years. The idea of spending a lot of money on something that has a 10 or 20 year payoff profile is not where their heads are at. So next slide again, I apologize if it's too simplistic, but essentially we're talking about interventions that ultimately save the user money, and that the financier has to put in the upfront capital cost. So if the client's not going to put in that upfront capital cost Jock's just discussed, and someone else has to, and can you utilize some of the energy savings to fund that? And the answer, as we all know, is yes, but the funder must recover an amount plus a reasonable return over the period of the finance. And so they need to be super comfortable that business is going to stay in business and is able and willing to pay them. So those are the two things we really focus on: able and willing. And maybe we can just dive into that a little bit. So what are the two major reasons that you're not going to get paid for funding a project? Are either, well, at the extreme end, the business goes under and is unable to pay you, or they're unwilling to pay you, or more leaning towards the technical end, the solution provided doesn't deliver the savings that everybody said it was going to deliver, and then there's sort of a double unwillingness to pay. It's not just a credit issue, it's an underperformance issue. So energy efficiency contracts can be financed in a number of ways. And I think, just going back to the other slide, I think people sort of mix the issues. At the end of the day, at its simplest form, the funder, and I'm repeating myself, the funder is paying for the project up front and needs to recover that cost over the life of the project. How that's structured is not as important as whether the client can pay it back. Once you've established the credit issues and you're reasonably comfortable that you've got a bankable client, then the sculpting of the payments, or how you recover those payments, is partially a function of the client's needs and partially a function of tax and accounting issues. So they can be financed on and off balance sheet. Why would you do that? So some clients prefer a rental arrangement where it's either rental or energy as a service, where it's completely off the client's balance sheet. And whilst there is a service element embedded in that, mostly clients do that because they don't want to be seen to have more debt on their balance sheet or be more indebted. Other clients want to reflect the project debt or the debt as a borrowing, so that they can take tax allowances or tax deductions or depreciation because they have use for it. And they're not worried about reflecting a bigger debt amount on their balance sheet. And we can go into that in quite a lot more detail. And in terms of sculpting the payments, well, I mean, it can be a fixed monthly payment. It can be an annual escalating payment, which looks a little bit more like typical electricity payments. Performance contracting can be used, and it can be used as a standalone. It can also be mixed. So there can be a fixed payment element plus a performance element. What I would say is, the more there is a performance element, the more that the financier will look to the ESCO. They'll always look to the ESCO from a credit risk point of view in terms of implementing the project properly upfront. But the more that there's a performance element that will be part of the payment structure, the more they need to be comfortable that the ESCO is going to deliver a project that delivers the savings that were modeled upfront.
So I just want to add to what you were saying there, just so it's quite clear, St. when you say you look to the ESCO from a credit point of view, what you're saying is when a financier is paying for something upfront before it's actually working, they are taking a risk on the ESCO itself. And I think that's something that, just working with financial people, I hadn't really appreciated beforehand, is that you're being paid by someone, and until that whatever you're doing is installed and working the way it is, that money is at risk from a financial point of view. And I think it's very important because often an ESCO will be asked to do a credit check as well, and you have just making that quite clear that there is an element of risk on the part of the financier.
Can I ask a question, St.
Please go ahead.
As well, on this topic of risk. So, do you get, or is it sometimes necessary to ask the ESCO to also sort of share in the risk, in the sense that the ESCO might be required to make let's say a deposit towards the funding?
No, I mean, so typically no in this sector. I mean, in massive projects, yes, but in this sector, no. But what we would do, and I don't want to repeat myself, but I mean, if you think about, if you put a financier's lens on, you as the ESCO have got a client you want us to fund. If I'm going to just take fixed monthly payments, then my real risk is that you do what you say you're going to do up front. So I'm probably just going to, firstly, I'm going to look to you to say, do you have a track record of actually doing these things properly in the past? One, do you have the balance sheet to order some of the equipment up front? Like, I don't want to pay you all up front, because then I financed fresh air. So do you have a balance sheet? Do you have some credit terms with your suppliers? And then we can structure something where we give you staged payments during the thing, but you're also going to be using your balance sheet to, let's say, order equipment, etc. And then once the thing's installed, I've got pure risk to the client. I have then assessed the client, and I'm trying to recover a fixed monthly payment. Where it changes slightly is if we've both committed that I'm getting a portion of the savings as part of my payment. Because now how you as an ESCO have modeled that project, I'm not going to have recourse to you, but how you have modeled that project and how accurate that is and how accurate those savings are becomes very material to me, and how much I'm going to earn from the client. Does that answer your question?
Yes, thank you. Yes.
Can I just also add in something here? And it's across all industries when you're dealing with suppliers of capital equipment or ESCOs, is that as a financier, we have to live with that customer for the next 5, 6, 7, 8, 9, 10 years while he pays us back. The supplier or the ESCO of the equipment normally gets full payment of their costs and the equipment at the time of completion of the project. So it's critically important for us to know that the person or the company that we're dealing with, the installers of the equipment, and the actual equipment says and does what it's supposed to do in terms of warranties, guarantees, and it's just an overall performance and a lifespan. So you're going to try and match performance and quality of equipment and workmanship with the duration of the actual financing of agreement. So typically what happens is when there's a breakdown or a situation arises where the actual original installer or the equipment provider is no longer in business, and the equipment doesn't do what it's supposed to do, the first person they want to stop paying is the financier. So that's one of the processes that we go through in terms of credit is validating the credentials of the ESCO on any project.
Yeah. So in conclusion, we don't typically ask for any contribution, but we do have a very good look at. We have what we call a panel of ESCOs that we partner with, and we will pre-vet those ESCOs to say, based on a whole bunch of criteria, are these people who we think can bank projects that we can fund?
I have a
So-
follow-up
so-
question onto that. Sorry, it's Nati here from Easa. So in the case of sort of your smaller ESCOs, so we went through as an industry a tiering process where you'd have tier 3, which would be your smaller, probably SMEs in the ESCO space, sort of a either startup to probably, businesses that make less than 10 million a year, and then and so on and so on. And you have your tier 1s, which are your larger sort of ESCOs. For the smaller ESCOs, which are usually your sole practitioners, it's a PTY, but it's usually one guy in there. He's got 20 years experience in the engineering sector, and he's sourcing projects, and he's managing to get some, but he wants to maybe do 1 or 2 larger projects. How do you look at that, credit application on their front? They might not have track record within the company, but as an individual or a professional, they do. How do you assess that risk?
So I think we've actually just been through this on one of our deals with Mark, where you can, and I suppose it's a combination of things. So, I mean, if you can get comfortable that the individual has track record from an implementation point of view, and you can tick that CV box, even if it's not the entity itself, that's one thing. There are other ways that one can sort of manage the risk to a smaller ESCO. So there are ways that we do agreements where we won't pay the initial progress payments, for example, will be paid directly to suppliers to secure equipment. And so you can sort of on a look-through basis down to the equipment suppliers and other people, you can manage the credit risk of engaging a smaller ESCO with a larger project. But I think the project size must warrant the extra complexity that brings to the funding arrangement, right? So you're typically probably going to charge a slightly higher rate, and in order to do those sort of see-through arrangements and now look through to equipment suppliers, etc., you'd want the project to be of a size that warrants that extra effort. Does that answer your question, Nati?
Yeah, no, makes sense. Thanks.
Mark, do you want to add anything?
No,
I see Devon's got his hand up, St. John.
Okay.
Devon, you're muted.
Yes, Fricky, thank you. So I have 2 questions. One as an LTM Energy Director, and the other as the President of the ESCO Association. So maybe let me go for the first one. What we find is, we noted there's various tiers of ESCOs, and what's the challenge right now is funding and getting the preferential rate, because when you put the numbers together, especially if you are, if you are actually becoming competitive against others in tenders or proposals that a client wants, from various parties, and to actually be competitive, there's international players coming into the commercial and industrial space. They used to be in the utility space, and they come in with some funding that it's very competitive, with international funding available. So that's one of the challenges I like to put down, and how do we overcome that is a huge issue right now. Okay. The second question I have is from an LTM perspective. We've done some PPAs and we've done some EPCs. To combine the EPCs with the PPA is what we call an energy optimization agreement. So we combine that. So, I mean, if you have, let's say you're funding lighting projects on the EPC model, take a lighting project is 5 years times 4 will give you 20 years. And that will align to the lifespan of a solar panel. Those type of things, we combine it. What's the appetite in the market for that? We've done it from, off our balance sheet. What's the appetite in the market to combine it? We call it energy optimization agreement for want of a better term.
So if I can answer those 2 questions. So the first one is, and it probably speaks to the slide I've got up. Granted, there is quite a lot of capital around, and there is foreign capital at preferential rates. But what I would say in sort of, at the end of the day, in any project, 80% of the cost of funding will be determined by the quality of the credit off-taker and the size of the project. So yes, a smaller ESCO might introduce a little bit of complexity, and So I've seldom seen a project not get away because it's got a smaller ESCO involved. What I'm saying is the cost of funding will be determined by, and I'm going down the bottom there, the DFIs, DBSA, AFDB, GIZ. Those guys are not interested in anything under a 50 million rand check. And they're going to do sort of project finance type stuff into small utility scale or larger projects. And then the green energy funds will probably play in their cost of funding is marginally higher than the DFIs, but the Sanlums and Mutuals, and I used to run one of those funds, their cost of funding is in the sort of prime to prime +3 type sort of space. And then it gets higher as you go up the spectrum. I think my point is project cost is largely determined, firstly, 70 or 80% is determined by the credit quality of the end off taker, and then probably by size, which are often linked. The last piece is the ESCO. Mostly what happens is you can't match really big projects or big off-takers to smaller ESCOs, mainly because of a working capital finance issue. So the issue generally is because regardless of who's financing it, they're not prepared to fund the whole thing up front. And the smaller ESCOs don't have the balance sheet to fund the working capital cycle. So I don't know if I don't know if that answers your question, your first question. In terms of your second question, the short answer is, yeah, we call them different things, but in terms of funding hybrid projects that are combinations of PPA, energy efficiency, and or storage and combining, let's call it multiple finance arrangements over different terms. So you might have storage financed over 5 to 7 years, you might have a 20-year PPA, and you might have energy efficiency over a shorter period. There's certainly appetite to fund, let's call it hybrid agreements. The key is that each piece of funding obviously has to match the useful life of the equipment. You can't put everything through the PPA when you've got an energy efficiency lighting arrangement for five years. They're going to have to, it's going to have to be a sort of hybrid financing arrangement. Jock, I don't know if you want to jump in.
Yeah, but I think you have mentioned, like, there are ways to do that. Like, you can have one agreement with effectively multiple payments on the same agreement. It's not necessarily one or the other, I guess. But I think the point is well made that the life of the equipment is absolutely critical to the length of financing that can be offered. So you can have in the same way.
Sorry, Jock, finish.
Yeah, go ahead.
So I mean, the same way any of you ever banked with RMB Private Bank, they had an interesting concept where they gave you one credit facility, but then they would give you different lengths under it. So your home loan would be 20 years, your car loan would be 5 years, and your overdraft would be a rolling facility, but it was all under one credit arrangement. You could draw different amounts for different periods. There's certainly appetite to do that facing one client.
So St. John, I'm going to jump in. I've got another question. When we talk about the useful life of the equipment, I think most of us expect that to be typically longer than your manufacturer's warranty. How do you manage that risk?
Look, typically we work to warranty period, to be honest. I mean, typically the finance arrangement and the warranty period have to match. I have seen some exceptions on smaller projects, but to be honest, it's where at the margin, it doesn't make a huge difference.
But I think
the bigger a project, the more likely we are to be a stickler for that. Jock, carry on.
Yeah, so I was just going to say there is a notable exception to that we engage in regularly, which is the power purchase agreement, where often you're offering 20, maybe even 25 years. But in that case, it's quite different because your financing arrangement builds in replacement costs for things like inverters, and like there's an O&M, you have a maintenance reserve to be able to replace some of that capital equipment. But that then becomes a much more complicated transaction, right? Because you've got you need to make sure that you're financing obviously the capital equipment, but then you're needing to make sure that everything's maintained in order to maintain those warranties as long as possible. You have someone contracted to go and do everything, which is why I think when we're talking about like these very cheap cost of capital and project finance, for example, you get much cheaper rates because you're putting this belts and braces system in place and you can spread it out over a very long period. But it all comes at a cost, and that cost basically means that you can only do transactions that are 50 million plus or whatever the number is. So, yeah.
Any more questions? See a hand up.
Yeah. Share through you. Yes, I just want to come in on the, we spoke about the different packaging where you can combine the hybrid model of an EPC versus PPA. Thanks for the response. What is the appetite of looking at technologies which is not the conventional, like for example, quad generation, which is proving now to be cheaper than the Eskom power, and there's competition there, and it's some form of renewable energy in itself because of the efficiencies. We also done conduit hydro, where you put those turbines in pipes, and it's proving to be about a third of Eskom price. That's from generation sources. Then on the efficiency side, we look at like phase change materials that's bring optimization in HVAC side. Sort of, let's call it not the conventional technologies. I'm just giving you some of the non-conventional, not people that, it's not usual in this market, right? I think there's only, I think about 3 or 4 sites on Trigen at the moment, but nobody I think has done quad generation. So we are, as a company, now focusing on sort of innovative and disruptive technologies. We've got some serious investors to pull us in that direction. And that's where my focus is, stepping down as a CEO of LTM. What's your thoughts on that from a funding perspective?
Jock, can I throw that one at you?
Well, I think just with new technology generally, like there is always someone that's willing to invest. It's just at what rate it makes them interested, right? So new technologies will find investors, but you're not going to get a DFI from Europe to give you very cheap, long duration finance on a new technology. So as new technologies come into the market, generally the first of kind is going to be funded by someone on either an all equity basis, or they're going to have to put a large portion of equity into that, much larger than we're used to on REIPP solar projects, for example, which get 18 to 20-year debt at like 80% of the total value or something like that. You're going to have to put in a much larger portion of equity, or what we'd call risk capital, which is the other people that lose their money first if things go to heaven. So there's always I think the answer is there's always someone willing, but it'll come at a cost, and it won't be DFI values initially. But if that technology is proven, then of course that changes.
Thank you, Jock. Can I just quickly jump in here? I'm keeping my eye on the time, and I love the fact that we are getting many questions. Maybe if I can suggest that if you have questions, can you post them in the chat? Let's allow Sinjan and the team to get to the slides. Sinjan, I don't know how many slides you've got left. I think it's about 3 or 4.
2. Literally.
2.
Yeah.
Okay, great stuff. So let's give Sinjan just an opportunity to get to the last 2 slides. Post your questions in the chat, and then we see how many of those questions we can address in the time that we have left. But thanks for the participation so far.
Cool. I'll move quickly, guys, and then we can get to questions. Look, all I want you to take away from this slide is, like everything in life, there's a payoff profile. DFIs write massive checks very cheaply, but I've never seen a project get away in under 2.5 to 3 years, and you're going to do what we call the DFI dance, and they only write $50 to $100 million, 100 million rand type checks. The green energy funds probably have a 6 to 9 month approval process for things like this. A little bit more agile. Pricing is probably above the DFIs, but they're not super agile. They're sort of small utility to scale type stuff. The specialist green energy finance houses like ourselves, like that's all we focus on, and we go right across the board. Maybe our cost of funding is a bit higher than the green energy funds and the DFIs, but we've got a quicker turnaround time depending on which sector we're playing. And I think we understand the techs, and the others do lots of other things as well. And then when you go out the other side, the specialist asset financiers, there are a lot of them out there. A lot of them are dabbling in the green energy and energy efficiency space. Their rates will be at a premium possible, or similar to ours at a premium possibly, but they're not specialist green energy players. So the tech is not familiar to them. They would view it in the same way that they view any type of machinery. And so there's some complexity in that. And then as Mark sort of introduced, in our experience with the banks, if you've got a bond you can access, if you've got a really good relationship with a bank and you've got existing credit lines, then yes, it's the cheapest form of funding, but it's a tick box exercise. If you don't meet all of the tick boxes, the deal tends to get thrown out. So life is a set of trade-offs from a funding point of view. And yeah, I think just don't confuse the cost of funding at the DFI level for an SME project. They're not the same. The one is not accessible to the other, would be my comment. And the last piece is also just speed of turnaround. Right. Jock, do you want to? I think you're on mute.
Yeah, sorry. Yeah, so I think one of the things we wanted to point out is that there's a range of different options for funding, and in the same way as choosing who might be providing the funding, once you actually have done that, there's other ways of looking at it in terms of options, and all of these have their different risks and benefits. Whether you go with your funding out of your own cash resources versus going with a bank, and then different types of contracts that we're used to dealing with ourselves, they all have trade-offs, and it depends on what your focus or what the client's focus is as a business as to what makes the most sense. Obviously, when you're dealing with self-financing, if the client's doing this out of cash resources, and ESCO is basically going to be acting as an EPC only and providing the product to the client, then basically all the risk is going to sit with the client at the end of the day. And that means both in terms of insurance and the operational risk and providing sort of repairs and maintenance to the plant. And it's much the same for bank financing. If you're getting a facility from your bank, again, you're going to be sitting with most of the client's going to be sitting with most of the risk themselves. The source of the capital is likely to be cheaper than if they're providing it out of their own resources. I think then there are basically two other constructs which are typical. There's obviously, everybody has different names for different things, but it basically comes down to whether you pay back your financing on a performance basis, meaning, in the terms of a power purchase agreement, this is like paying by the kilowatt hour. In terms of an energy efficiency performance contract, it's you're paying based on the amount saved, or an installment sale or lease type arrangement where you're effectively paying a fixed monthly installment. And there are, in terms of from a technical point of view, the performance contract, obviously the financier, the ESCO, is taking the sort of technical risk in that, because if the solution doesn't work, then they're not going to get paid. And then obviously in this installment sale type arrangement, the client is taking that technical risk because they're obliged to pay a fixed amount each month, regardless of the savings produced by the solution.
We've actually left one option off. So we also have a rental option. So a rental option behaves exactly like an installment sale option, except that it's on our balance sheet, not the client's balance sheet. So it's, but it doesn't have a performance element. So you can structure it as a rental contract. I think, at the risk of repeating, and I don't want to, but at the risk of repeating, from a finance point of view, though, the credit is the client is either good to make the payments over the period or they're not. The exercise of how we structure this then becomes more of a tax, and whether you want to show the debt on your balance sheet or not, rather than the different arrangements don't change the creditworthiness of the underlying client.
Yeah.
The last slide. So I suppose it speaks to some of the stuff I've just said, and you guys can read through it yourselves. But really, what are the questions I would be asking of a client to try and ascertain what sort of financing would suit them? Do they want to take debt on their balance sheet? Can they make use of the depreciation allowance if there is one for the equipment? Do they have access to finance? Do they have access to cash? And then in terms of documents and info required, I've just listed stuff from our checklist, which I think is pretty standard. Mark, I don't know if you want to jump in here. In terms of the sort of the typical information one would want to gather maybe initially to assess the creditworthiness of a client.
Yeah, sure. So clearly, the starting point is obviously an application. And thereafter, we're doing normal standard credit checks on the individuals that own the business and the company and any other group companies inside that group. And that's just to see that they've got a clean bill of health and that they pay their bills and their accounts. Normally the credit bureaus give us a score, and that kind of tells us the propensity of the customer's willingness to pay based on past historical performance of their accounts. And that's just the starting point. And then you want to have a look at, obviously, clearly the financial performance of the business. And generally speaking, you would look at the last audited accounts and then their latest trading accounts, which is their management accounts, if the AFS are more than 6 months old. Typically in the SME space, not always as easy as it is to get all of these type of things. So there are different ways that we look at things. We get copies of bank statements, assets and liabilities of the shareholders, just to see the value of their guarantees. And once you have an understanding of the credit package and putting all the pieces of the puzzle together, it's pretty easy to make a credit decision based on that. Thereafter, once the credit decision has been made, then you would follow through with the other lovely to have kind of stuff, which is the SARS VAT certificate, utility bills, and all the FICA requirements and that make up the compliancy checklist. But more importantly is the ability of gathering the right information to make an informed credit decision. In the capital boxes case, we don't expect the ESCO to do any of that for us. We want you to actually stay out of that process altogether. We have a team of specialists in the field who understand exactly how to manage that process, what questions to ask for, and we alleviate you from that responsibility entirely. So the only requirement that we would have from you is obviously is the quote for the project and the name of the customer that's pursuing and going ahead with the project, and their contact details, and we'll do the rest. If you give us the introduction, we'll take over the financial packaging, and the one thing that we will do is we'll provide you with ongoing communications as to the progress lack of access of the actual credit application.
Thanks, Mark.
Yeah.
Yeah. So we'll circulate a copy of the presentation to you that you can, Fricky, so that you can send it out to those who would like.
Thank you, Sinjan. I see we have a question on the chat from Vimal. Vimal, don't you want to jump in and ask the question sort of in person? Vimal?
I mean, maybe we can respond. I think I understand the question he's asked, Fricky. He's basically
Okay,
asking, sure. If I understand correctly, what is the risk appetite of equity investors for new interesting technologies? And I think the answer is unfortunately not clear cut. Like it really depends on what the technology is, what it does, and what the savings are likely to be. And you know, with new technologies, if you can prove it works, you know, you have your development program and testing results and pilots and whatnot showing that the technology does what is written on the box, then you're going to find an equity investor to get that to work, assuming the project's going to provide adequate returns for them to meet their hurdles. Yeah.
Okay, thanks, Jock.
There's a hand up.
Kulekani? Yeah.
Good day, and thank you so much for the presentation. Just a couple of clarity questions. I saw in the options that you had presented, I didn't see an option where the ESCO is the one that is selling the energy. So the asset is on their balance sheet. So is that something that the banks are frowning upon? Because I saw most of the options, you have the client having the assets with them for the duration of the loan term. And secondly, in terms of the equity to debt aspect, I think it's a critical one in your past experience. What's typically the split? And do you guys have any instruments that assist the ESCOs in structuring their equity side? Because if there's an 80-20, it's 100 million projects, the ESCO still needs to raise 20 million from their side. And if they can't raise the 20 million, the project will fall flat. So are there any instruments in that particular regard that you guys have helped structure in the past? I'll just pause there for now.
Jock, I'm going to look at you. I'm not familiar with, I mean, I'm sure that there are business banking arrangements for banking ESCOs, but I'm not familiar in our space with a sort of construct where we would fund the ESCO who then funds the client. But I'm looking at you, Jock.
Yeah, so I mean, I think there were two parts to the question there, and I think is if I understood correctly, was what we've described as performance contracting, where effectively that's a PPA or a contract where you get paid based on the performance of the energy efficiency measure. So that was what we're thinking. And then in terms of equity, regardless of where the money comes from, an ESCO is always going to have to put up some portion of its own money. So if you can get someone to fund your equity, you may be able to go to an equity investor and get them to fund your portion of the equity. Regardless of that, you're always going to have to put up something of your own money in order to make that work. Is that not right, Sinjan?
Yeah, I'm not sure we've got the question right. I mean, I don't know. Do you want to clarify?
Yeah, so definitely you do need to put some money into the project. So the first one was on the split on the debt to equity ratio. So on the project that you've structured, what's the typical split that you guys know of? And then secondly, are there any instruments that you have arranged or that you do arrange to help the ESCOs minimize the weight on their equity side?
So maybe, the way I'm hearing the question is typically I'm not familiar with arrangements where we have essentially invested or funded projects through the ESCO. Generally, the client has had better credit risk than the ESCO, and so therefore it is, in my experience, always made more sense to fund the project rather than the ESCO themselves. In terms of project equity and debt, it really depends. It's very difficult to get, the short answer is it's very difficult to get debt for small projects. If you've got a bankable off-taker and the individual project, and I'm sucking my thumb here, but if it's more than, when projects get north of 10, 20 million, you can start to look at getting specific debt for a project. But in terms of any sort of SME, medium SME type projects, unless the off-taker actually introduces their own debt and you provide some of the equity, it's very, very difficult to get debt for specific projects. Jock, I don't know if you've got anything to add, or Mark?
No, the only thing I'd add is on big projects where you're looking at project-specific finance, the debt to equity ratio is calculated based on the cash flow of the project. A lender is not going to give you a greater ratio of debt than they are certain is going to get repaid by that project. So it really depends on the cash flow of the project.
Yeah. Thank you.
I see we've got Yolanda's hand up and Nati. I think
Yolanda from Institute of Energy Professionals South Africa. My question is relating to the evaluating the actual project being funded. I would like to know what is considered, is any consideration given to measurement and verification within that project, and that the client has an energy management system. So in other words, what standards do those projects, do you give any credit for that?
Jock, all yours.
Yeah, look, we lean heavily on ESCOs in that regard and following international standards when it comes to measurement and verification. That it's not our area of expertise by any stretch of the imagination. So we rely on the ESCOs to undertake M&V on behalf of the project, and in a performance contract, the ESCO will obviously be contracted by the finance or the project company or whatever the structure is to provide that service to the project, and it's obviously always required to be done in line with the local and international standards as relevant to the specific project. But I mean, it really is only relevant to performance contracts when it's asset finance, where you're paying a fixed amount each month, whether it be an installment sale or a rental agreement. The M&V doesn't count for much at all. But when you're doing performance contracting, it's incredibly important. Like, it's obviously one of the most important things.
Nati?
Thanks, Ricky. Gentlemen, I just have two questions quickly. What are sort of the costs involved to fund the project, the initial, ongoing, and closing costs, just to give us an idea? Do you have sort of admin fees? Do you have, those transaction fees? Just to understand that, and obviously you then amortize those over the lifetime of, or over the do a technical feasibility, do you provide assistance on the modeling side, sort of then, calculate those returns, the revenues, the cash savings, etc.? Then that would then form your debt funding structure that you then propose to the client. Thanks.
Jock, do you want to kick off or shall I?
I can answer the second bit, the first bit on fees and admin and so. I mean, there's obviously cost with putting contracts together. You need to employ lawyers and whatnot, do credit checks, register bonds or leases or whatever else. So there are costs involved. I think the second bit, sorry, can you start again, Nati? I've forgotten what I was talking.
Okay, the first bit, so would these sort of be your transaction costs? They'd be maybe 1 to 5% of the total contract price, just an expectation on the contractor side, right?
Maybe let's answer that first. I mean, I think it really is very different from so if it's project finance or a sort of small utility scale project, a lot of those upfront costs do get put into the model and spread over the life of the contract. If we move down to the more asset finance, if we're talking the MSE, like the SME type deals and the corporate type deals, on a rental or an asset finance basis, I mean, we would typically, there would be there's upfront fees, raising fees and upfront fees to cover like documentation and mark staff that have to go out and liaise with the clients and gather all the information and process all the information. And we often, not always, will try and get the client to actually pay those upfront fees, because as a financier, you're trying not to finance as much fresh air as possible. And let me put something tangible to that. So when you've done a project and you've taken your margin and you've installed whatever the solution is for the client, that's all we've got to go and fetch if the client defaults. So from our point of view, the labor's gone, the markup's gone, and any fees that have been charged have gone out of the project. So if the equipment cost was 50 cents in the rand, what are we going to get if we go and fetch that equipment and we go and sell it if the client defaults? So for the smaller deals, we typically would charge raising fees. Those would, in most cases, be cash funded by the client, and then we would fund the capital balance, which would be the invoice amount, in a set of progress payments over the life of the contract. Mark, do you want to add anything?
No, I think you've said it all. I think absolutely though. I mean, there are structuring, initiation, and documentation fees, which are standard in the industry, regardless of whether it's renewable energy or whether it's other. And those, typically, we do try to get those up front. And the structuring of the actual payment would be to allow, from a cash flow perspective, is that the first installment typically wouldn't be at the same time as collecting those fees. However, in saying that, depending on the credit worthiness of the customer again, and their cash flow requirements for the project, it's not unheard of that we do capitalize those fees and amortize that over the life of the transaction. So yeah, so we can do either, but we always try to get them up front.
We might be a little bit over time, but on the second one, it's just to understand, looking at my experience, you do have a couple of sort of technical experts, but they might not have the financial nous on the other side. Do you provide any assistance? Because you said, you directly approach the customer and you work that side in terms of financing. So would you then say, well, we'll take your technical feasibility and then prepare a financial model off of that, or how would that work?
Again, I think it's project size specific. So on the very big, on the bigger projects, certainly we can assist with modeling. When it's down to financing an invoice, and again, I'm going more to the commoditized end of the market. And I suppose I'm talking projects between 500,000 and 2.5-3 million rand. It's not really worth our while to model. I'm not saying we won't. I'm thinking of some of the solar we funded. We've got a very simplistic sort of model where we'll help the client model the savings and try and model the cash flows to break even with their first year. in terms of, so in smaller deals, limited, yes, but limited. Larger deals, yes, we're able to, is the very short answer.
Okay.
Just so we're clear, there's financial modeling and there's financial modeling. Particularly on the smaller transactions, which are more vanilla in style. There's obviously a certain amount of modeling that we do, but it's more around cash flow ability to repay, linked to original start-off energy costs, to try and get it as close as possible to where they're currently paying, and to alleviate some of the punishment in terms of what that cash flow may or may not be in year 1 and year 2. So if that's what you're referring to, we absolutely do get involved in that. And we do provide some kind of assistance to that customer when he's trying to make up his decision whether there's affordability in the project or not, and whether this is it's a worthwhile exercise for him going through. So
one last comment on that. I mean, I think we always try and split out anything that has to do with security of power from savings. So we often look at the client and say, look, you're doing this intervention, be it energy efficiency or solar, is delivering this saving. But if you want to add an element that adds security of power, you may have saved 20% off your bill on your starting bill, but you want to add back 30%, so you're at a 10% premium. I suppose we always look at those two things separately.
Okay, thank you very much, gentlemen. I think we've reached the end of our webinar. If we have maybe a last round of questions from the audience to the panelists, else I will wrap up.
Yeah, Nadia, I think there's a question that Jared posted on the chat, and then I see Devin's got his hand up.
Okay.
But I think that should be the last 2 questions, and then you can go to closing.
Great.
So maybe let's ask Jared to just ask his question. Jared, do you want to go ahead? Jared?
Jared? Okay, I can ask the question on Jared's behalf. I think it's Jared is asking, are there any guides or advice for onboarding SMEs to energy finance? Mark and St. John, I think probably the presentation, can you share the presentation with us? Because you do have, I've seen some of your documents, they actually do detail some of the benefits, and how you would become onboarded as a technical partner on the project.
Absolutely.
Okay. Oh, that's great. Jared, has that answered your question? I mean, I think it's a broad question. It's not easy, but it depends on the financier and what their requirements are. But largely, if you then approach the financier, then they say this is what we require. But initially, they give you sort of a brochure with some project experience detailing what they do, what products they can provide or instruments. And then you would then, and the risk appetite, you would then assess that from your perspective and say, is it worth engaging with them or go to another one, I would assume.
Yeah, I mean, just to loop back to the beginning of the presentation, mostly we're going to want to establish your track record at what it is that you do. And we would want to establish that you have the ability to finance a project through the way we handle progress payments. I mean, I'm keeping it super simple. There's documents we would gather to get there, but those are the 2 main questions we would be asking.
I think the key point is that, energy service companies should not be afraid to approach financiers. The guys have the money. They want to undertake projects. And if you can, it's still a new sort of area for most of us in the country, but internationally, there is best practice out there that we can rely on.
Yeah, I just want to. Yeah, I'd like to add to that. We are in the business of lending money, so that is our stock in trade. And if we're not lending it, then we'll go out of business. So just to add to your thing, there is a willingness from our side to find a means and a way to lend money.
All right, Dev, your question. Thanks, Jared.
Yeah, thank you for the opportunity. I just want to state that the problem we have, and I think,
Dev, you just sound a bit faint there. Can you increase your volume on your side?
okay, can you hear me now?
Oh,
Mm.
yeah, a little bit better. If you can just project probably a bit higher, thank you.
Okay.
Maybe your mic's volume is a bit low.
All right, just let me get this right. All right, can you hear me now? It's much clearer.
Yeah,
No,
yeah.
All right.
Go ahead.
So,
Yeah.
so just on the fear factor is something that we have to work with because of the upskilling of our ESCOs, and I think the enablers to it. When we had that workshop with DMRE, the roadshow, and World Bank presented where we can use some of the templates that they've given us, like the power purchase agreement. I mean, we as a company spent like over 50,000 Rand for a power purchase agreement. And, to have that in place, or financial modeling that needs to be done, what model you use and the packaging, etc. So there's a lot of training and development that needs to take place. And if, some of the local companies can work with the World Bank in how we can make this available, these sort of tools available for our ESCOs and across the spectrum, even those that not entered the green economy, SMMEs that want to come into the green economy, and the tier 1s to tier 3 ESCOs. I think it's important and how we can work together as a team to make these tools available. On the second thing is, of course, the upskilling, and to get rid of that fear factor. The fear factor is because I don't know any better. How do I approach this? I've seen a lot of, I think when we hosted a presentation at the Barnyard, for some of you who have made it, we had DTI, we had IDC, and a whole host of people talking about funding available. And one of the biggest concerns is there's lots of funding available, but the applications to access that funding is of poor quality. And in IDC, we actually arranged for them to have somebody available to educate and train, or ensure the quality. There's a dialogue between the ESCOs and the funder, being IDC. So that went a long way. So we need to look into those sort of mechanisms to get away from the fear factor, because I think that is quite a big, red herring for me is the power purchase agreement. If you want to get it right, there's a huge legal cost to it. And if you run one, why can't we use it and share the template, like the World Bank sharing the templates? And please note, the World Bank has made that available for us. I think it's going to be on our website as well soon. All these templates are available, but we need to customize it for our local conditions.
Can I respond quickly? I know we're over time. I mean, it's noble, and I've seen a lot of these projects, but actually where the industry is right now, I think it's actually, our biggest problem has been when we've got people who thought they had a PPA template, for example, that they thought worked, and they've gone and banked what they think are 10 or 15 projects on their PPA. And they bring them to us and say, okay, please, can you bank these projects? And we take one look at the PPA and go, I know this is a template, but we're not prepared to commit to these documents because we've got a different PPA. And as I say, I think it's a noble idea that there would be sort of one standard PPA out there, but practically it's actually been one of our biggest impediments to providing finance, because then the ESCO says, well, I can't go back to the client and recontract with the client on your PPA, and then the project doesn't get refinanced. So my one sort of caveat to that is sometimes it's better to engage with your financier up front and find out how they want to execute documents and what templates they want to use, and then you've got a better chance of getting the deal away.
St. John, I want to, that's my last remark. I want to agree with you 100%. I have erred on the side of an ESCO trying to speak finance. And you create expectations, unrealistic expectations, and sometimes you're just factually incorrect. And then when the financier actually starts to talk to the client, it's all sorts of damage control and quite possibly.
Quiet there.
Hello.
I can hear you.
Okay. So yeah, no, I think it's worth noting the comments that St. John made now. Get the financier involved right up front, make him part of the process, make him part of the deal. so that whatever the technical solution is aligned with the financing and the documentation and the contracts and the agreements from the word go.
Right, thanks, Ricky. Gentlemen, I think we're way over our time, but it shows the appetite, to obtain the knowledge and to understand. There's projects out there, there's funding out there. It's just how do we meet each other in the middle? Hopefully, we can have follow-on webinars or sessions, probably a training session as well for Easa members on the cards. But I would like to thank Senjin, I'd like to thank Mark, I'd like to thank Fricky, I'd like to thank everybody who's been involved, from the panelists to the organizers, the Easa board for giving us this opportunity, SAEEC as well, Tida, Gabriel, really do appreciate your support and throwing resources behind this initiative for our members. And hopefully you have been a lot more enlightened around the various debt and equity structures or instruments that are available to you. The players, I think there's a slide there that St. presented to us around the various players and tiers and the types of funding they can offer. That's quite critical for you to understand. This will be shared on the SAEEC website. And if you have any other questions, hopefully I'm not speaking out of turn, Mark or St. Are available to respond to them and hopefully assist you in financing some of your projects that you have in your pipeline.
Thank you very much. Thanks to everybody for hosting us. Thank you, Fricky.
Thank you, Sinjin. It was a great presentation. Certainly met and exceeded my expectations. Thanks a million. Thanks, Jock and Mark, and everybody who joined us. Thanks to all the ESCOs who joined this this webinar. Yeah, I think just last remark from my side. I said it in the opening. We will send out a questionnaire, a survey. We want to hear what your thoughts are on this webinar, where we can improve. Do you want to follow up? What sort of topics do you want to see us covering in that? And hopefully this can be the first in a series of webinars. I'm of the opinion that there's a lot of good projects out there looking for funding. And if we can bring the money and the projects together, we can shift the needle. And the needle is the greenhouse gas emission needle, which I guess we all do what we do because it has meaning for us. And by matching projects with money, we can add greater meaning to what we do and have a greater impact. So thank you, everyone. Have a great day.
Awesome. Thank you.
There's one request. Sorry, before we go, I think Tida asked if we can all switch on our video. I think she wants a group photo or something. I'm not sure. Tida, can we just get a picture and we all smile and look happy and clever? And
yes, with pleasure.
I know everybody enjoyed it. I know everybody enjoyed the webinar, but I'm quite sure all of us are eager to see each other. Yeah, so I will be posting this picture on our Facebook page as well. So if you want to tag your friends so that they can see, you're welcome. I'm going to give another 10 seconds for the rest to just quickly switch on their videos. Okay.
Great stuff. Can we smile or is it done? Thanks, Tida. Thanks, everyone. Thanks, Motsad.
Okay.
All right.
Cheers. Thank you very much.
Bye.
Yes, bye-bye.
Thanks.